That was some inspiring presentations. My name is Børge Sørvoll. I'm the CFO of ArcticZymes, and I'm going to talk a little about our financial profile and the capital allocation that we see in the coming years. Over the last few years, the company has grown significantly. We have managed to have a financial healthy position. We have more than 265 million in cash as a combination of both cash and mutual funds. We don't have any debt, and we have a 94% equity ratio. And the majority of the cash that we have on our hand today is coming from the operating performance that we had, especially over the last few years, but also based on after we divested the former subsidiary, Biotech Beta-Glucans, back at the end of 2020, where we generated close to 80 million in free cash. So this financial position gives us the resilience across cycles when markets are maybe going against us. It gives us now the flexibility to operate and do what is right when times are a little bit tougher. And it is strategic as well for us. But also, looking at the sales side of the business now, and as Michael alluded to in the beginning of this presentation, we've seen a good growth in our sales, and these you can see sales where we also kind of excluded the COVID-related effects. We've seen a strong ramp up until 2022, and then we saw kind of a decline in the market. And now in 2025, or last year, we saw a momentum. We were gaining momentum again, and we saw sales growth. But also, at the same time, our operating expenses have grown in the last few years, and especially during the COVID years. And you can see this has also been deliberate, and also this one, the expansion we see in our OpEx now, gives us the opportunity, because now we have invested the majority of investments that we need to do. So now we are set for margin expansion in the coming years. So we'll generate better margins in the underlying business. So overall, you can see we have a strong platform now for long-term value creation. This slide is telling you a little bit about what I talked about now. It's saying why our revenues are expected to outpace the cost growth of the company. Personnel expenses remains the core cost of the business here. 2/3 of all of our expenses are primarily personnel expenses. And this reflects also the knowledge and IP-driven nature of our business. And it's also, over the last few years, we have changed the organization somewhat. As we talked about, we have a much more customer-centric focus now. And we have almost doubled the number of people that are in customer-facing roles now. So more R&D people are also in customer dialogue, much more than before. On the right-hand side, you can also see how our expenses have grown over the last 5 years. And now we have plateaued in some way. We have, if you exclude the personnel expenses, our operating expenses have, over the last 4 years, been in the area of between 30 to 35 million. And we do not expect that this number is going to increase significantly in the coming, at least in the next couple of years now. But if there will be expenses, these will be kind of commercial-driven expenses and marketing investments like we've done over the last year, where we have kind of increased our presence in the market. We are spending a lot more time and money at conferences and also in that social media platform. And we've also hired more people to do the marketing for us now. So what does this actually mean? So it means that we have now, during the kind of the COVID-related years, we have transitioned from the reactive expansion that we were forced into by that. And now we have a commercially driven and a scalable growth here. And this is now in the future supported by a disciplined and leverage-ready cost structure. On this slide, I'm going to talk a little bit how we potentially see the margin expansion in the business that we have. And this should not be interpreted as guidance on how we believe the numbers are going to be, but it's more kind of how we see it if the business develops as we hope it will. And on this chart, you can also see that from 2025, we had a revenue of around 120 million. EBITDA margins are still on the modest range with 10 to 15%. And as the revenue scales up to 250 million, we also see that the EBITDA margin is becoming a little bit better and moving up to the 2027 range is how we believe it. And then if we jump up to 200 million in revenues, we expect that our EBITDA margin is going to be somewhere in the ballpark of 30 to 35%. Gross margins are expected to remain at this kind of same level at no matter what kind of revenues we have. They are expected to be in that 95 to 98% level. And we also see that once the cost base we have in this company, once the cost base is covered, basically every krona of revenues will flow efficiently down to the EBITDA margin because of the high margins that we have. But first of all, we need to cover the fixed cost base that we have. We also see from the bottom here that our EBITDA is expected to grow from that 12 to 18 million range at 120 million up to 60 to 70 million once we get to that 200 million mark. So this is kind of the operating leverage that we have in our business, and we expect it to grow as the revenue grows as well, to improve. So what about capital allocation moving forward now? Our first priority is organic growth. It is about that commercial execution. It's about innovating new products. It's about ensuring that we have the capacity to produce the products that are needed for our customers. And to have a strong cash position also underpins the long-term stability. And it signals that we are a dependable supplier for our customers as well. And as I think both as OXB alluded to, it is important to have that capacity to ensure that you have security supply once they move into kind of the next level and once they are reaching those commercial stages. And it's not just about producing products, it's also about having to ensure that we will be there in the long run. So it's also about financial stability that we can give that to our customers. But on the other hand, to have this free capital of around 260 million, it gives us optionality. And we are also prepared to act on opportunities that might arise in the market. But it needs to also be strategically aligned. It needs to be value accretive for us as well. But I think at the end, we have talked about it in the past as well, but it needs to be for the right reasons, and we're not going to do anything just because it sounds like good. It needs to be definitely for the right reasons. So you can say, in summary, our cash position and the financial stability that we have, it gives us strength to grow organically today, while also preserving the flexibility to grow with inorganic expansion tomorrow.